Now let's come to the four methods of budgeting, including the incremental budgeting, zero-based budgeting, rolling budgets, and flexible budget. Here we go. So let's start with incremental budgeting. When it comes to incremental budgeting, it's a traditional budgeting. It's traditional type of budgeting, which involves that the company set up the next year budget based on the actual real results. So actual results of this year, so they set up a budget for next year. So it's the same, but they add increment on the top of it. For example, let's have a look here. If you look here, you will see that for this actual year, 500 units, sales 250,000, variable cost including labor, material, contribution, which is the total sales 250,000 minus the total cost 150,000 equal 100,000 pound total contribution minus fixed cost 30,000 equal profit 70,000. So as you see, this is for this year, the actual results for this year. So for next year, what's gonna happen? Based on incremental budget, we take this actual results and just we add an increment to them. For example, 5%, 6%, 3%, 4%. You add 4% or 5%. For example, this example, to set up next year budget, you need to add 5% extra on the top of each. So if you add extra 5%, you should be able to set up a budget for next year. 500 times 1.05 straight away, 525 units, and you do the rest of it the same technique. As you see from here, that's easy to prepare. It's easy, very simple, straightforward. There's no issues here, as you see. Based on last year figures, easy. But the disadvantages, as you see, it does really encourage a slack in the budget. One of the things that slack in budget means when the managers they do over they put the expenses, they over budget they over budget the expenses for next year, and they under budget the revenues for next year. So why? Because next year, when they have, of course, they have less expenses, they have more revenues, more sales. Here we go, the management did very well, and the manager takes bonus. That's one of the disadvantages there. Also, may only spend to meet the budget in terms of managers. I mean, if they said, okay, next year my budget for marketing £5,000. This means this is my budget. I need to spend this. I'm gonna spend it, right? For example, we talk about labor. Next year, £20,000. So here we go. We need to spend it, right? But that doesn't have to, right? What does that mean? This means, okay, maybe we don't need £5,000 or £10,000 budget for next year, right? So again, that's type of things manager may only spend to meet the budget. Only for sake of to meet the budget, I'm gonna spend £5,000. So throw the money. Of course, in this budget, we assume that economy is stable. So as a criticism, as the disadvantages, as I mentioned, so it's a bad practice, really. It's a bad practice, and really, it doesn't really improve the efficiency of the business. Really, it is not really something the business should look at, because it does have really bad practice there. The second budget we will look at is the zero-based budgeting. Zero-based budgeting. Now we understand in terms of incremental budgeting that we just, based on the actual results, we increase an increment for next year to set up a budget. But as you see, we do not justify any budget or any figures or anything, but for sake of it, just here we go, we do it. But with zero-based budgeting is different, another story here. Okay, it's another story. With zero-based budgeting, we justify every single activity there, every single cost, we justify it, right? So this is the question I'll ask yourself. Yeah, I told you, okay, why do we need really £5,000 for marketing next year, or we don't need? If yes, here we go, we justify it. As long as we justify it, here we go, that's zero-based budgeting. Okay, so I would recommend you that to look at this video. It's really good video to look at, so it does give you a lot of information about zero-based budgeting within a few minutes. So again, zero-based budgeting was preparing the budget from scratch. Yeah, from scratch. So every single year we prepared from scratch. Yeah, and every single year is treated as it being the first time it's launched, right? Can you see there? Can you see? It's really important, especially it's more efficient when you look at allocation of resources. What do I mean by resources? I mean, okay, if we need more money to the marketing, we give more money to marketing. If we need more money to labor, we give more money to labor. Yeah, if we don't need money for marketing, why should we allocate a lot of money to marketing and they spend it for useless things? Yeah, so this is something you need to like. So try to distribute it according to efficient model allocation of resources. In terms of responding environmental change, remember that every year is different, so it depends on every year, as I mentioned. So if we don't need this specific cost or this specific resource, so we need to rid of it, so we don't need it really for next year. Creates a questioning attitude. When I say this questioning attitude, I mean about the justification, right? So when I say, okay, every single cost must be justified, yeah, here we go. So what does that mean? As a managers, they set up a budget, they need to look at, okay, we need to justify this cost in this case for next year. If there is no justification, there is no zero-based budgeting, so you do not include this cost. And of course, that all comes to value for money in terms how this budget is being set for next year. Of course, as disadvantages, you can see how much time is consuming, because you are going to launch or prepare this budget from the scratch every single year, and you need to question, you need to justify every single cost. Again, can you see how much time consuming? Can you see the high cost involved there? Can you see how much information required we need for this? Again, all these type of disadvantages of zero-based budgeting. Let's have a look at this example for zero-based budgeting. If you look at this company, they're preparing a budget for next year. They expect to sell 10,000 units. So the cost of these 10,000 units, so the selling price is £150 per unit. The material cost are £50 per unit. So £50 you multiply by 10,000 units. For labor, it takes 1 hour per unit at the cost of £10 per hour, and overheads also it takes 2 hours per unit at £5 per hour. Okay, very simple, easy, right? What you need to do, if you look here, guys, what can you see? We calculated the sales, and as you see, sales, you multiply the number of units by the selling price per unit. We have material, labor, overhead, again the same. We multiply it by the hours and the price per hour. Very simple. And at the end, we find the total cost and the sales, and you deduct and you find the profit. This is the only simple way how to do the budget for next year. The third method of budgeting is the rolling budgets. Right? When it comes to rolling budgets, this budget is based on continuously updated, right? What does that mean? This means the budget, we update the budget every 3 months, for example. Yeah, for example, every 1 month, 2, 3 months, we update it, right? So we don't leave the budget for 1 year, we updated it. Instead of preparing a periodic budget annually, so what we need to do, we update the budget in short period of time. It's why it's important for this rolling budget. It's because I try to prepare plans and target that more realistic and certain in a way, isn't it? Right? Because you know you can expect in the next 3 months what's gonna happen, but it might be difficult to expect for the next year what's gonna happen. So as you see, in terms of uncertainty in an unstable environment, this is the right budget when it comes to uncertainty. Yeah, if you look at when in Brexit time, how the economy was unstable, the virus COVID-19 is all these events and cause unstable environment, unstable economy. A rolling budget is one of the methods can really work better for the business. Of course, when we say a realistic plan, in terms of realistic plan, right, to update the budget every 3 months to be realistic more. Of course, this is type of appraisal to appraise performance, because you see every single 3 months you appraise the performance, you evaluate the performance, you see, okay, here we go, great, so how can we improve the next 3 months? And of course, this is a motivation to staff to achieve a short period comes to budget. In terms of disadvantages, can you see, if every 3 months we're gonna update it, we need money, we need time, we need preparation, we need training. It's really important when it comes to this. But also remember that rolling budget may not be really necessarily great in a stable environment. I mean, if you look at economy, the environment is stable, no issues, no conflict. So why do you need a rolling budget really? I think you don't need a rolling budget, because it's, if you look at the history, you'll see, okay, that's all stable, so we don't need it. So the business needs to understand this. This is one example of a rolling budget. As you see, this is for the 4 quarters, as you see. So based on this example, if you look at the bottom in the red, you see that 3% increase in sales, cost of sales and distribution. So you need every quarter there's a 3% increase. For example, 18,000 multiply 18,000 pound multiply 1.03. This comes to quarter 2. So quarter 2, 18,540 times 1.03. Quarter 3, 19,096 times 1.03 comes to quarter 4, and on. So you need to do it in every single quarter, and also that's including sales, cost of sales and distribution cost. You add 3%. This is only just an example of what, guys, of rolling budget. Right, here we go. The last budget we will look at here is the flexible budget. The flexible budget. If you look here, what you can see here, you can see that static budget are prepared for single plan of activity. Now, when it comes to static budget, it's only for one level or single level of activity. So it might be really the evaluation, performance evaluation might be difficult. Why it might be difficult? Because the actual level of activity might be different from the planned level of activity, and there is a difference in terms of activities. This means it's difficult really to evaluate the performance, because of course if we have less activity, we have to expect less cost. So the point here, that if you compare the static budget with the actual cost is like you're comparing apples with oranges. So let's go and look at this example. If you look at cheese core, right, this is a static budget. When I say static budget, I mean by the apples here. Based, we have 10,000 activity levels, machine hours, and if you look at the questions, we have the indirect labor, 40,000, indirect material, power, fixed costs, including depreciation, insurance, total overhead costs, etc. So 89,000 total overhead cost. If you look at the actual results, this is the actual results. What happened? It's based on 8,000 machine hours, not 10,000 machine hours. Can you see now there is a difference in what? In level of activities. There is a difference in level of activities, and that's what makes it really difficult to compare. In terms of variable cost, you look guys here, you look indirect labor, we have 34,000, indirect material, power, depreciation, it's the same, but in terms of insurance, there's £50 extra when it comes to actual results, and the total 77,350. Of course, you think straight away is gonna be less. Why is gonna be less? Because we have less activity levels. 8,000. Of course, it's gonna be less straight away. But the question is, how do you know that we have done a good job? We need to know that we have done a good job in controlling the expenses, or just this is for it's we saved money because of the activity level is less. So if you look at the variances means the difference between the planned, the budgeted, and the actual results, and this is the variances. Unfavorable and for you, unfavorable for F green. Favorable means good for the business, unfavorable means not good for the business. So as you see, these are the variances there. If you look at the bottom, you will see that total overhead cost, the total overhead cost equal 11,650, and as you see, it is favorable. What does that mean? This means the business saved 11,650 pounds. But in fact they don't. They don't, in fact, really. Why they don't? Because the question, what we need to do, guys, the question is what? Okay, these also just only the lock here. So the actual costs are less than the budgeted cost. Excellent. But this is the question we need to ask. This is the question you need to ask yourself. Have we done a good job controlling cost? This is the question. And my opinion, we haven't. Yeah, why we haven't? At least we haven't by 11,650. Could be a small amount. Why? Because look, the activity levels is 8,000. So of course, as a result, we will have less cost, and of course, as a result, we have favorable. Yeah. In this case, to answer this equation, so it's not gonna work with a static budget at all, right? No way it's gonna be. Absolutely no way. So the question is, here we go. So so shouldn't variable cost be lower if actual activity is lower? Of course, yes, that's normal. Yeah, that's normal. Yeah, in this case, guys, in order to do this, to answer this equation, so the question, always put it in your mind here, how much of the favorable cost variance, the one we just calculated right now, yeah, at the end, the 11,600, is it due to lower activity, and how much is it due to good cost control? Can you see? So now, how much is it due to lower activity, and how much is it due to good cost control? So again, in order to answer this equation, what you need to do, you need to flex the budget to the actual level of activities. This is our job for the next 10 minutes or so. So how to flex the budget right now? So if you look here, if you look at the 11,650 pounds, this is favorable, right? So we need to ask this question: how much is it due to lower activity and how much is it due to good cost control? So when we say flex the budget, right, I mean by flex the budget, I want the actual results to be equal 8,000. So 8,000 must equal 8,000. So the actual level of activities must equal 0. We shouldn't have variances there. We shouldn't have variances, right? So let's have a look here. So this is advantage of flexible budgets. We did explain it at the beginning. And the central concept, that means that's a way you need to rid of level of activities in order to reach to you eliminate the variances in level of activities. The measure of activities, of course, when it comes to measure of activities, you need to calculate the variable cost per unit, and once you calculate the variable cost per unit, you just multiply it by the actual level of activities. So we'll come to it in a bit. You will see it in the practice. So remember, when you flex the budget, remember that the total variable cost change in a direct proportion to change in activity. Remember this, because this is what we learned. In terms of fixed costs, remember that costs remain unchanged within the relevant range. Let's prepare a flexible budget. Right, here we go. If you look here, you will see this is 10,000 hours, the 10,000 hours, and we have the 8,000 hours, which is that's just level of activities, isn't it? Just level of activities. We also have a 12,000 hours. So we have 3 level of activities, as you see. We have 3 level of activities, as you see here, right? So can you see here, variable costs are expressed as constant amount per hour. So in order to continue and fill the 8,000 and 12,000 hours here, so you need to calculate first the variable cost per unit, the variable cost per unit. When it comes to variable cost per unit, you know how to do it. Very simple. 10,000 divided by, the amount you divided by the level of activities. So if you look here, the amount of indirect labor, £40,000, you divide it by level of activity, 10,000 hours, so you should be able, that's £4 per indirect labor. So that's £4, you multiply it by 8,000 hours, and also you multiply by 12,000 hours. So, but you need to rely first on 10,000 hours, which is the static budget, in order to calculate the variable cost per unit, as you see here. Can you see? So you multiply, this is the variable cost element, you multiply it by 8,000, and also you multiply by 12,000. And this is the final figure here, as you see. So, but the question is, you need to use the static budget, the 12,000 hours, in order to calculate the variable cost per unit. If you look below, you see the fixed cost, including the depreciation and including the insurance. In terms of depreciation, it's fixed cost, and we did say in the fixed cost, if you go back to the previous slide, you see that fixed costs do not change, total fixed costs do not change with the production or with the level of activities. And also we have insurance, again the same. So if you look ahead, what you can see here we go. As I mentioned, do not change in the relevant range activities. And now let's prepare flexible budget. Right, here we go. So now we know that from the activities here, we know that the actual one we did it is 8,000 hours. Here we go. So in this case, what we need to do, so you need to take this 8,000 hours, the 32,000, the 74,000, the total overhead cost. You need to take it and put it here. So here we go. 74,000 is the flexible budget, right? So, but the actual results, what is the actual results? If you go, where is it? If you go back the beginning, if you remember the beginning, in the question, here we go. This is the actual results. Yeah, this is the actual results of the orange is 77,350, right? And this is the actual what? The actual results here. So I'm comparing the actual result, the 77,350, with the flexible budget, the 74,000, the one we just did it right now, based on different level of activities. So it's like I'm comparing an orange with an orange, and this is what I want. This is the point. The point of flexible budget is to compare an orange with an orange. The point is to eliminate the variances. The point is to eliminate the variances in terms of level of activities. And you see, we don't have any variances in terms of level of activities, right? So here we go. So if you look here, based on 74,000 and 77,350, can you see this is the final figures? This is the final figures from the previous slides. So you can see right now, things change, isn't it? So right now you see that we have at the end 3,350 unfavorable, right? Adverse to the business, adverse, unfavorable, right? So, but before it was 11,000 something favorable, good for the business. Now it's completely the picture changed. Why it's changed the picture? Because why? Because look at the activities level. The activity levels is what? Is zero. Is what? Is zero, right? Is zero. Now, if we go back to our equation, if you remember this equation, we asked how much of the total variance is due to activity and how much is it due to cost control. And here we go. I'm sure you should be able to answer this question right now. Okay, when it comes to this question, how much of the 11,650 pound, the one in the first slide, is due to activity, and how much is it due to cost control? Remember this. This is the first slide, the first thing we started with flexible budget. And look here. Look here. When it comes to the actual overhead, yeah, the actual is based on 8,000 hours. And the cost is 77,350 pound. When it comes to the static budget, is based on 10,000 hours, and this is the cost 89,000 pounds. So as you see, the static budget, which is 10,000 hours, is different from 8,000 hours. So you cannot compare orange with apple, isn't it? You cannot simply. But if you look at the middle now, what we have in the middle, we have the flexible budget of 8,000 hours. So now we need to put the flexible one, the one we calculated later, the flexible one of 8,000, which we did right now. It comes to 74,000. So the logic behind to say that comparing orange and orange, one orange with an orange, is it due to cost control? The difference is going to be due to cost control. By comparing an orange with the apple, is going to go, that's it due to what? Due to the activity levels, due to the activity level. Okay, so this is the point of a flexible budget. This is the point of flexible budget. Okay, so the last thing quickly now, what causes the cost control variance? So as you see, when it comes to cost control, we didn't do really good job, right? We didn't really good job. We didn't really make a saving. Actually, we didn't meet the target of the budget. We overspent, really, and that's really bad for the business to have adverse variance. So you need to look at and find out why. So of course there are a lot of reasons behind, but of course one of them, we spend too much money, and we spend too much money, and we spend too much money on resources. Also could be that we use the resources inefficiently. And this is one of the things. That's why, for example, we use less skilled labor, and the less skilled labor took more time. Yeah, that's one example. Another example could be the machines. The equipment are really old, and that takes more time to make the unit, to process the material. The material is not quality. Yeah, if the material is not quality, we have a lot of waste of material. There's a lot of reason you need to consider when it comes to the causes of variances, when it comes to unfavorable. So what is the future of budgeting? Remember guys, we did explain the 4 types of budgeting, methods of budgeting, but remember, this is very important to remember one thing, that the business, when it comes to prepare a budget, they don't use only one single budget. They can combine more than one together. They could combine incremental with zero-based with rolling budgets. So again, so it's not really a theory, here we go, just one budget behind. I always remember that businesses nowadays and the future, they go and they tend to go more into rolling budget, to apply rolling budget, because rolling budget they found it is really realistic and they can update it every short period of time. Yeah. Again, last thing, remember that is all about the future. Budgeting is all about the future, not the past. And the future is very important for the business, and that's exactly what controlled by the strategic plan of the business. Right, that's all guys. So yeah, so thank you very much for listening. So guys, so go ahead, any question, let me know. Otherwise, have a lovely day and God bless. Thank you.